Ladies and gentlemen, welcome back to the channel. In this video, we are going to be talking about the math of asymmetry. And what I mean by that, I mean why high win rate doesn't mean profitable. So I prepared for you this presentation because actually this is a big misconception that there is out there, let's say, on the socials. So if you are one of those trader who thinks that having a high win rate and maybe low risk reward system is profitable and feels safe, this video is actually for you, because I want to break down everything from my point of view, from my experience, okay, from what I have experienced, for you, in order to open your eyes and let you understand why win rate alone and risk reward alone are not a thing. An higher win rate with a low risk reward is not a thing. A low win rate with a low risk reward is not a thing. So that has to be combined. And if you don't know how it works, definitely this video is for you. So stay with me. Okay, the math of asymmetry. Why this is very, very important. This is important because out there, because of the general narrative that you have on socials, people think that an 80% win rate, sorry for my drawing, with maybe a 1-to-1 risk reward, so a fast, let's say, risk reward, price tap in and goes instant or goes to stop loss. So this is very fast. But an 80% win rate feels safer. And so people think that having a high win rate is the key. But that is actually opposite, because this is a false friend, okay? Why that? This presentation is about that. So the asymmetry, okay, because I just want to, introduce you the concept. Asymmetry means basically that you have a high risk reward. So this is the risk, this is the reward. So you risk 1 to get 5 in this specific situation. You will see that for this presentation, I just broke down my system and I have an average risk reward of 1 to 7. So this could be a 7. So I want to show you, comparing with proof, with calculation, why a lower win rate, high risk reward is better than a high win rate and low risk reward. Okay, so let me just get rid of all the drawings. Perfect. And let's move on. Oops, sorry. Okay. So for this presentation, I compare two systems, and I've tried to be more realistic as possible. The first system is system A with 60% win rate and 1-to-1 risk reward. Why not 80% win rate? Not 80% win rate, because 80% win rate is really unrealistic. Unless you are talking with a scammer, okay, or a trader that it's not in the market, for a long time, and maybe he had a positive streak, and so maybe he has an 80% win rate. An 80% win rate is highly unrealistic. A 60% win rate, that means 6 out of 10 operation trades are take profit, that is huge, is more realistic with a low win rate. So this is the first system, 60% win rate and 1% risk reward, compared to a 20% win rate. And I know that when you're looking to this number, you are thinking, what the hell? 20% win rate means being right only 2 times out of 10. This is horrible, awful. Actually, it's not like that, and this is why. The secret is the risk reward. So all the presentation bases on the thesis that a low win rate and high risk reward strategy or system is better than this one. Oops, sorry guys, than this one. So I want to show you why this is better. even if you think right now that this is better because it feels safer, because it gets to the profit faster, because it feel like you're doing something right because you take profit. So this is all misconception that have been built throughout the years from the social narratives because of what they teach. And they don't teach real trading, they teach hype, they teach really something that actually doesn't work. Okay, so stay with me, because now we are going inside the math behind all these words that I'm saying on this presentation, and all the theses that I'm here to bring to your attention. So sorry, expectancy. This is the only thing that is important, and the calculation is very simple. We are not going into math, but just for you to know, the expectancy is calculating, multiplicating the win rate and the reward minus the loss rate times the risk. Okay, so for example, if I have a 20% win rate times the reward, because my system is 1 to 7, so 7 minus the loss rate, so 80% times 1. Okay, does it make sense? So 20 times 7 is 140 minus 80. So the expectancy of the system is 0.6 R per trade. So this means that it doesn't matter, okay? It doesn't matter what the single trade does. I have a positive expectancy of 0.6 R per trade. It doesn't matter the outcome of the trade. On average, every single trade that I take with that system, if profitable, obviously, gives me 0.6 R. Okay, so this is the expectancy, the EV. Okay, guys? So, let me clean this up and move on. So now you know, guys, that this is the only thing that important. And you see how both things together, win rate and risk reward, just play a fundamental role, because one without the other, it's just bullshit, it's just useless. Okay, you can't be profitable just having a high win rate. It doesn't mean anything. Okay, we could have 100% win rate and maybe a 0.1 R of reward. It feels weird, okay, and it is. So I'm just trying to make you understand, to open your eyes, to make you reasoning about that, why that misconception of high win rate is actually holding you back from having the best profitability you could have ever experienced. Okay, guys, so bear with me. System B is 3 times system A. So we made a calculation. Okay, so this is the calculation that we made. 1.40 minus 0.80. For me it was 140 minus 80, but it's the same thing. Okay, so we have a 0.6 R for system B, as it's a positive expectancy, so the EV, the E, is 0.6 R, while for the system A that has a 60% win rate but 1-to-1 risk reward, we have only a 0.20 R for the system. Okay, so this is the big difference. So just from the backtest, just from the math, just from a math perspective point of view, system B outperformed system A by 3 times, and this is huge if you think about. So what we were thinking, what was safer, 60% win rate, actually gives us less money than a 20% win rate. So think about how it could feel weird hearing or listening to that for the first time. You basically have a system that wins 2 times out of 10 and makes you much more money than a system that wins 6 times out of 10 but actually gives you less money. Think about that. It's weird, but it's math. So we are talking about math. I'm trying to make you understand that all what I'm saying is not me preferring system B. It's math. You know? We can't argue with math. So this is another thing that we are going to talk in a minute, because this is the actual win rate once you take the system live. Because when you take the system live, you need to account for slippage, you need to account for commission, you need to account for spread. So there are a lot of things that you can't test in the backtesting phase. Okay, so only from a merely math point of view, we are outperforming system A by 3 times. Let's go on. Okay, this is where actually lies, okay, the secrets, the reason why a low win rate system but high risk reward is actually better, and in time, in the long term, in the long run, performs better. So basically, these two systems, so system A and system B, actually are two systems for different market conditions. What I mean by that? To have a 1 to 7 risk reward, I risk 1 and I get 7. Basically, that means that I have to find myself, okay, bear with me, in a condition where the market is basically continue going higher, because I need to risk 1 to get 7. So that means that if this is my entry point, I need a trend to persist until my take profit, get taken. If I have the system A, so this is the system B. If I have the system A, and this is actually why I use Miro, because it lets me, write and show you the thing. So let me know if you like this format, because if you like this format, I will be doing more video with that. Okay, sorry for the interruption. System A, that is a 1-to-1 risk reward, high win rate, basically mean that you can apply this system basically everywhere, because you get tapped in and you get tapped the take profit or the stop loss very fast. So you don't really need a trend to persist. You don't really need to catch, let's say, the right movement. You don't really need to be behind a good market context or condition to actually actually go to the take profit. So that means that you are pushed to think that a system like that you can, let's say, apply almost in every market condition, okay, it's better. But actually it's not. Because what I mean by tight stop loss and wide stop loss, it not means tight stop and wide stop in terms of size, but in terms of room, that they give to you in order to, let's say, be able to get to the profit. Okay, so bear with me, guys. If I have this system here, so 1 to 7, I basically need to have a good market condition. If I have this system here, I basically can, trade everywhere. So if I have this system here in this market condition here, it's useless. It's not worth, because if I know that on average on that market condition my system gets a 1 to 7 R, okay, why should I use a 1-to-1 risk reward, leaving on the table 6R on average every single time? Okay, so This is why something like that is not utilized in this environment. And so this is why this kind of model is not a good fit, because this kind of model is only utilized if you want to get to the take profit faster, because you don't know the outcome. Basically, you trade this system one-to-one to get to the take profit faster because maybe you are in a accumulation zone, and so you know that you have, quote unquote, less room to take profit because actually the market is ranging. But this is how you are taught basically to think if you follow the general narrative on the socials, the general gurus, and basically the old smart money concept and things like that. Unless you're talking about the 1 to 100 our trade, that is not realistic. Okay, so either way. So basically, if you are in this kind of condition, okay, it doesn't mean anything to use a one-to-one risk reward, because basically everything you are putting your trade, you are riding the trend, you are following the trend. So it really doesn't matter to have a one-to-one because you are leaving money on the table every single trade on average. So if you use this system, it's because you are trading out of context. Okay, so I think you now are getting the point. If you use this system, it actually means that you are trading out of context. And what I mean by out of context, in a market that has no clear direction or clear, let's say, a clear direction of where it wants to go, because it is in range. It's in accumulation. So basically market, it's accumulating order for to push the market in the right direction. But you are anticipating because you are trading in a bad environment, basically because you have been taught that you have to trade every single day, that you have to trade out of context, that you have to have a low risk reward because that means having a higher win rate. And that is correct, because the less is the risk reward, the higher is the win rate. It obviously is like that. But again, I just want to repeat that concept another time in order for you to understand it very, very, very deeply. If I have this system works only, let's say, quote unquote, works only in a bad market condition. Because if I know, let's say that somehow I know where the price wants to go, and I know that I am in a trend, the natural consequence of knowing that I am in a trend is wanting a higher risk reward, because I want to ride the trend. So I'm pushed to improve my risk reward to catch all the move. So suddenly a system like that doesn't work anymore because the market condition, the context changed. So this is very important, guys, because actually this is where people fail. This is where traders get trapped. This is basically where people quit, okay, in the trading space, because they don't understand this big difference. They don't understand that even hedge funds, looks. I mean, when you let's talk about hedge funds. So let's talk about the highest level of what we're doing, what we are doing here. Hedge funds looks for stock picker. Okay, it's a little bit different, but just bear with me. What a stock picker? A stock picker is a person, a trader that through analysis, fundamental, technical, quantitative, it doesn't matter, knows, on average, that stock A is going to outperform. So I need to be a stock picker, a good stock picker. But what does it mean really to outperform? I buy here and I find the price here. So basically I'm riding a trend. So a good stock picker is a trader that knows how to recognize a stock that has potential, a stock that has money behind it. Okay? So Even the hedge funds are looking for people, for traders that actually understand and knows where money could flow in and actually act based on that. So basically everyone is looking for high risk reward because you want to risk small to win high. It's not worth to risk small to gain small. A one-to-one risk reward, mathematically speaking, is not worth. You can have a positive expectancies about that. Okay, why that? Because when you have this kind of, let's say, numbers, this shows you that actually you can win. Okay, so I just came back because I want to talk about this one. Okay, and this one, obviously. This is the back test. This is the live. Obviously, this is the back test, and this is the live. So actually, when you start to account for spreads, commissions, slippage, actually your win rate is not a 60%, because 60% in a back test, in a safe environment. When you are live and you are experiencing slippage, commission, spreads, actually your win rate is lower. So in a system like that, a one-to-one, so low win rate, low risk reward, high win rate, actually you have, and I'm going to show you this one here, you have 12 points of live decay. So basically you lose 12 points of profitability, of win rate. When you are in another, okay, in another context, let's say, in another system, that is another context, because this applies only in one context and this applying only in another context, because of what I just, told you. You have only 2 points of live decay. That means that you lose very little in terms of win rate. So what this actually means? If you think about the structure, okay, and this is the key. If you think about the structure, so let's say that this is system A and you are basically trading in a range, and this is system B where you basically trading in a delivering market. Okay, here actually you don't know where to put your stop loss, so you put stop loss, you put the stop loss smaller, okay, because actually you want to get to the profit faster, and so you need the stop loss to be smaller, because you don't know where price is heading. So in any given point, in any given moment, the price could turn back and hit your stop loss. So you need a small stop loss to hit the take profit faster. This is the general understanding behind a one-to-one risk reward. Okay, then we have, it's true, you can argue that we have also system that maybe target like the accumulation and something like that, but this is even worse. Okay, because in accumulation maybe you spend months and months and months staying there, and maybe you have locked in money just to have a one-to-one risk if you're lucky, or a loss after maybe 1 month. It depends on the time frame, it depends on everything, but basically you want smaller stop losses because of that. Okay, on the other hand, what we have here is completely different, because knowing the structure of the market, so knowing that price is heading, in a certain direction, and knowing the market structure, we actually know where to place our stop loss when we get position. And so that means that commission, spread, and slippage, knowing where to go, matter less. And this is a real breakthrough if you think about that, because if you know how to position your stop loss, because you actually know, and this is not the video where we talk about how you know that, but if you know that market is going, let's say, there, because of the composite theories, because of Wyckoff, because of cycle, because of accumulation, because of how money is printed and how money works, and all and all these things. You actually know how to put your stop loss, so your stop loss get it less, and commission and slippage doesn't affect you much, 12 against 2, because actually price is going in your direction. Does it make sense? Because this is a real breakthrough. If you understand something like that, guys, you really have everything you need. Okay? This is very, very, very important. Very important. And this is actually the key of everything. This is the key in understanding why a high win rate doesn't mean anything if the risk reward is low. Obviously, having a high win rate, high risk reward would be perfect, but it's unrealistic. Because if you need to catch a 1 to 7 move, not all the move will catch 1 to 7. So maybe one goes to 1 to 3 and come back, the other 1 to 1 and come back. So you start to implementing break-even points, and this is another topic that is not part of the process. But this is why this is the difference in the live decay. Because actually, if you know, let's say, where money is going, you can act accordingly and position yourself in a better way. So this actually is what happens after a live execution. This is what happens after a test. Okay, so basically here, since we have a win rate of 48%, that is less than 50%, because we would be at break-even with a 50% win rate. 1-to-1 risk reward, 50% win rate, it's break-even. But actually, having lost 12 points of decay, and this is everything, it's based on math, we are just negative. So this is why in the long run this system is negative, while in the long run this system that has only a 2%, a minus 2% point, actually is a plus 0.73 R. So look at the difference. Even if this one has only a 20% win rate, so that means that 8 times out of 10 you are wrong, and this has a 60% win rate, okay, then it is 48 and 18, but it's the same thing. So the difference is huge. So this is why you need the best way to approach a system, not because I say that, not because I learned that, but because of math. It's better to have a lower win rate but higher risk reward, because you are actually targeting pocket of action, period in times where market is really, and I say again, really delivering, and you actually can ride the wave. And you could argue that a system like that works only on that kind of environment, and I would agree 100%. And this is another big misconception. You don't have to trade everything. You just need to trade good market condition. And when I say good market condition, I mean market it's delivering. So if you have a market that is doing like that, what's the point of being involved there or putting our money behind that? There is no clear direction. If I know that after this context, that is not a good context, I see price delivering, constantly delivering. This is actually where I want to put my money, and this is where a high risk reward lives, a high risk reward system lives. And this is actually where you need to trade to make a system like that works. But this is actually how it works, because the math doesn't lie. So this system doesn't work in the long run. This system, yes, but to apply this system, you need to understand that. You need to understand the context, you need to understand where price is going, you need to understand the composite operator theory. Just, go on Wyckoff and, look for the composite operator theory, because There is a word behind, the composite operator theory and the accumulation and the cycle and things so on. This is not a point of view. This is math, guys. Okay, this is very important. And now, this, is how it looks. So this is system A, where you basically have a win rate of 48% because there is the 12 point of decay, and this is the system B, where you have a 18% win rate. Okay, 18% win rate because we have the 2 points of decay. Look at the difference. Look at the losses there. Then look, it's huge. It's 53% of losses. Okay. And this is again is huge. It's 49% of losses, but the difference here is this and this. We have only 18%, but every single time we win, every single time we are right, we gain 7R. Here we have 48% of time that we are right, but every time we are right, we just get 1R. So we don't have breakevens, as you can see, 3% against 29%, because I don't know if you saw the other videos, but I already talked about why it was in a, if I don't wrong, it was in a recap video. I already talked about the why breakeven saves your equity curve, and I will be doing another video specifically on that topic, but bear with me. These are losses and one risk reward. So you have, let's say, losses, one risk reward. Breakeven is 3%, so it's nothing. Let's say breakeven, losses, losses, 1, 1, 1, losses, 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 1, 1, 1, 1, losses, losses, 1, losses, 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 1. This is actually how it works in a system like that. This is completely different, and this is why this exists. Okay, so a system like that works completely different. It's breakeven, breakeven, loss, win. Breakeven, breakeven, loss, loss, breakeven, breakeven, loss, breakeven, win. Breakeven, loss, 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 breakeven, small win, breakeven, breakeven, small win, loss, breakeven, loss, win. Look at the equity curve. This is completely different. This is where this exists. You know those numbers? Look. You see it? You see what I'm saying? This is the math behind everything, and this is why you need to look for a low win rate, high reward. Okay? And this is the psychological reality. You don't need to be right. You need to survive being wrong. You know? So look at that. This feels safer because you have average streak losses. We are talking about losses 6.3. Okay? 6.3. And this is 17. But actually, this, it's better because every time you gain, every time you are right, you take 7. Here, you take just 1. So even if we have an average streak of consecutive losses bigger, way bigger, this is always better than this one because this survives being wrong. This now. So I hope that this is very clear because actually here is where stands all the difference in the world. This is where lies the underlying secret sauce of the profitable strategies out there, and this is actually a simulation. 300 trades, 1% fixed risk. This is way too high, but this is a simulation, so it's okay. 400 simulation. So we have 400 simulation Okay, and look at that. This is the better simulation with risk B. This is the worst simulation with risk B. But look, and this is the average. So we are going to talk only the risk the average. So this is what I was doing before, against this one that is basically something like that. And as you can see, this has no positive expectancies after 300 trades because look, it's not going anywhere. Look at this one. Look at this one, how the curve is growing. Even in the worst scenario, look at the difference between that and that. So this is actually what you need to look for if you are a trader, if you are serious about the career of being a trader, and if you really want to build something that is sustainable in the long run. There is nothing else to say. This is all math applied to the trading, and this is the underlying truth why choosing a low win rate, high risk reward system is actually better. It pushes you to trade only, and I say only, and I want to underline the word only in good context market, because actually it's only good counter market that allows you to ride the wave and to have higher risk reward. So this is actually how it works, and I really hope that this video help you in understanding everything what's about the real truth about the market. I hope that this video help you in opening your eyes and understanding that the majority of things that you see on YouTube are just there to hype, are just there to sell you something, are just there to make visuals, are just there because they want to make money online, but actually they're not a trader. So you saw from a mathematical point of view why it's better to have a low win rate, high risk reward. So every time you go on YouTube and see something different from that, you see someone says that basically you can trade everywhere. You can trade a liquidity sweep. You can trade at 9 a.m. because it's New York Open, London Open, whatever it is. I even don't know when the sessions are. Okay, I really don't remember when the sessions are. You will understand that they are basically just marketer because they don't know what they does, because that things don't work. So I really hope that this video was helpful for you. And if this video was helpful for you, just let me know, because I really like explaining things. And if you know the format, okay, if you like the format, let me know, because I want to walk you through more details video like this one, with the presentation, with the Miro, where I actually can show you things and write on the presentation. This is actually something that I like doing, so if you like it, you let me know. Subscribe to the channel in order for you not to miss any video, and remember that I am live every single day, today included, at 9:30 a.m. New York time to trade live with you this system. A 1 to 7 risk reward with a 15-20% win rate. Okay? Thank you for watching, guys, and remember that if you want to contact me, if you want to talk with me, if you want to chat with me, you have the Telegram group. The link is in every single video and on the YouTube description. Okay? Thank you very much, and I hope this video could be your real breakthrough to the future profitability. Thank you for watching, guys.